Well, hello, everyone. Welcome to Fiducian Advisors' first quarter capital markets review and outlook update. My name is Chris Cashmore. I'm joined today by my colleagues, Rob Lowry and Paula Ramunchuk. Our goal today is to spend about the next 15 minutes providing you with an overview of some of the larger themes that are driving markets more recently, along with a bit of a deeper dive across asset class performance and some expectations there. So let's get started. Investors continue to take their cues from developments really on two fronts, and those include stimulus efforts, both fiscal and monetary, and then gains being achieved with vaccination distribution. I think as we've discussed with you many times since the onset of the pandemic, the magnitude of stimulus remains unprecedented and really unrelenting. Most recently, we have as evidence the passage of the $2 trillion American Rescue Plan Act. The makeup of this act is highlighted in the chart in the upper right-hand corner of the page, and you'll note that a meaningful portion of the stimulus is being directed to individuals, which could encourage consumer spending, and that's important, of course, because consumer activity constitutes about 70% of GDP. This act follows on the heels of the CARES Act last March, the Consolidated Appropriations Act in December, ongoing discussions in Washington relating to a potential big infrastructure spend, and taken together, right, an indication to us that the government is using any and all of the means at its disposal to bridge the economy toward more sustained growth. Monetary policy remains highly accommodative, as you all know, with the Fed consistently reiterating its pledge to keep short rates low, to maintain its pace of quantitative easing activity. The runway for these stances we think is long, as the Fed is very focused on, hyper-focused really, on not getting in the way of the economy as it continues to repair itself. And we taken collectively, we think all these factors have us guardedly constructive regarding the near-term fate of markets. Let's shift our attention just briefly to the matters of inflation and interest rates. You'll see a graph in the lower left-hand corner of the page. Expectations for a fully reemergent economy in the back half of this year and into 2022 has brought with it what we'd best label, I think, front-running effects in the way of higher inflation expectations and higher interest rates. The Fed has talked at great length about its intent to let inflation run a touch higher than its standing 2% target, and expects that to happen in the coming month before it reverts back, inflation reverts back down to target levels later in the year. So we're mindful of a bit higher inflation here near term, but we don't view it to be of an immediate or pressing concern. And as noted, interest rates are moving a touch higher in the new year. They're still very low from a historical standpoint. We think that move higher in rates actually is for the right reason. And again, that's in anticipation of an improving economy. So let's shift our focus for a minute to the issue of market breadth. You'll remember about midway through the fourth quarter of 2020, we began to see a shift away from the large cap pandemic resistant areas of the market toward things like small caps and the value segments. And as you see in the chart in the lower right-hand corner of the page, this trend persisted through the first quarter. I think as we've mentioned in the past, these types of rotations often begin in advance of new economic cycles, and we find this trend to be an encouraging development for that reason. Let's shift to the next page. We've already touched on a number of these themes already, but just a couple more details here we thought would be of interest. You'll see the chart in the upper left-hand corner plays on this idea of somewhat countervailing forces with respect to inflation, stimulus and falling unemployment, right, as potential sources of higher inflation. But if you think of the evolving dynamics of the labor markets itself, here portrayed with participation rates kind of working in the other direction. So again, while we don't think inflation is of an immediate concern, although it's certainly something we'll continue to monitor carefully on your behalf. And then finally, I'll finish with just a quick note or thought around GDP growth forecasts. You see those in the upper right-hand corner of the page. The world, as we all know, consolidated last year economically, but is poised to grow over the next few years. And in a nutshell, right, this is where investor optimism really centers. Is this expectation that the global economy is poised to strengthen and grow, and supported and justified for all the reasons we just outlined, right? Again, those center on stimulus efforts, vaccination distribution, maybe a little bit of a head start here in the US, but with an expectation that the rest of the world begins to catch up on those fronts as well. So with that as a big picture update, I'm going to now turn things over to Rob as we begin to work our way through the capital markets. Rob?
Great, thanks, Chris. Broadly speaking, it was another risk-on quarter for financial markets, really driven by the rollout in the COVID vaccine, both here in the US and abroad, and that continued and renowned optimism for economic recovery. US small cap equities led the way, up almost 13% for the quarter. US large cap up almost 6.5%. International equity markets were also positive, but did trail the US market. Real assets and alternatives, and Paula will get into more details on the equity and real asset front in a moment, but US equity REITs having a strong quarter, up almost 9%, and commodities up almost 7% as inflation expectations moved higher and oil prices moved higher as well. If you turn your gaze to the left side of the page, it was a tough environment for fixed income investors this quarter. Higher inflation expectations, the continued economic recovery really driving interest rates higher. And as a reminder, bond prices move inversely with interest rates. So as interest rates rise, bond prices fall. That resulted in core bonds returning almost negative 3.5% for the period. The main driver there being the rise in interest rates. Higher yielding areas of the market, which investors continue to seek in the low rate environment, fared a little bit better, helping to offset some of the interest rate movement. High yield municipals and high yield corporate bonds generating strong return or positive returns in the quarter. Let's dig a little bit deeper into the fixed income market and see what happened. The US 10-year yield, really the driving factor from an interest rate perspective, and duration being the key driver for manager performance this quarter. The US 10-year yield rose roughly 80 basis points or 0.8% for the period. And what we also saw was a really big steepening in the yield curve. The spread between the 2-year yield and the 10-year yield started the year at roughly 0.8% and ended the quarter at 1.6%. So a big move there, really impacting longer duration assets compared to shorter duration assets. And you'll continue to notice that yields within 1 year continue to remain really subdued. As Chris alluded to, the Fed remains accommodative, targeting that 0 to 0.25% Fed funds rate, and really allowing the economy to run hot and let inflation run hot until we get a sustained recovery. Generally speaking, spread sectors outpaced treasuries. Corporate bond spreads tightened modestly in the period, really helping to offset some of the interest rate movement and negative price movement there. High yield having the largest excess return out of the bunch here compared to the US Treasury market. So generally speaking, fixed income investors overall, rising interest rates had a negative impact, but tightening corporate credit spreads and spread sectors offered some relief there. With that, I'll turn it over to Paula to touch a little bit more on the equity and real asset front.
Great. So as Rob mentioned, equities generally speaking performed relatively well in the first quarter of 2021. And really what that's done is pushed valuations higher across global equity markets. In the top left chart on this slide, we have cyclically adjusted PE or CAPE ratios, which are just one metric for valuing equities. And really what we're showing here are current CAPE ratios relative to history for the US, international, developed, and emerging markets. And what you can see is that current valuations are well above historical averages, most notably in the US. Now, it's important, it's important to recognize that while valuations are a critical component to our capital market assumptions and really kind of what we're expecting in terms of a forward-looking return, but it's also important to recognize that just because valuations are high, that doesn't necessarily mean that there's some sort of market correction that's on the horizon. So, given the current state of the economy and just general financial conditions, improving, we are generally constructive on equities, but acknowledge that, valuations are certainly elevated. In terms of performance for the first quarter, as Chris alluded to, we continue to see improving market breadth across equity markets. And really what I mean by that is we're no longer seeing just a handful of large growth-oriented tech names drive performance. In the top right chart of this page, what we show here is contribution to return broken down for the S&P 500 sectors. And what you can see is that financials were the top contributor for this quarter, for the first quarter of 2021. Financials, along with other kind of more value-oriented cyclical sectors, for example, energy, really suffered when COVID first hit last year, but have rebounded very nicely, really kind of starting since last summer. Interestingly, energy is the best performing sector since those March lows that we saw last year, returning 116% since that time period. And then financials not too far behind at a 98% total return. Technology, certainly still a strong performer. That sector, it did lag both energy as well as financials and returned about 90% over that same time period. So while this chart in the top right is just the S&P 500, so it only captures US large cap stocks, this same theme of improving market breadth really is evident across regions, styles, and market caps. So now turning to real assets, similar to equities, we did see relatively good returns for the first quarter, just with the encouraging economic growth prospects and higher inflation expectations that did benefit most real assets. On the commodity side, energy was a strong performer with a notable rise in oil prices. We saw a barrel of WTI crude oil start the year at $48 a barrel and then ended the first quarter at 60. So some pretty healthy performance there. Precious metals was one area that underperformed, perhaps not hugely surprising considering that gold is a meaningful component and largest component of that index. And gold tends to be seen as a safe haven asset. So with a fairly healthy and improving economic backdrop, there typically is less demand for gold in that type of environment. In terms of real estate, the chart on the right-hand side of this page shows first quarter performance for the different sectors of the FTSE Nareit index. And really what you can see here is that those sectors that were hardest hit by those pandemic lockdown measures, so for example, retail, lodging and resorts, those areas continue to recover and really recoup a lot of the losses that were experienced last year. So just kind of taking a step back from a bigger picture perspective, we are generally optimistic about vaccine development and distribution, and that really should drive more business activity and ultimately support a relatively solid economic backdrop. So thank you for your time and interest today. If you have any questions or want additional information, please reach out to your consultant or anyone at Fiducian Advisors, and we'd be more than happy to connect. Thanks and be well.